Mohamed, you've had a bit of time to chew over this one. What's your big takeaway?
John, it is a jobs report that confirms U.S. economic exceptionalism. You're having a strong supply side, strong demand side. So if you look at the economy continues to benefit from the favorable supply shock. If you look at the Fed, that's not going to change much what the Fed is thinking. And believe me, the administration will be celebrating this report. So overall, a very strong report that just confirms that the U.S. is an economic exception among the advanced economies.
Jeff Rosenberg, do you believe this labour market report is a report this Federal Reserve can fully embrace?
Well, it can fully embrace it, but it is a little bit challenging around the timing issue. I think the key thing in this report we haven't talked about is labor force participation and its impact offsetting some of the wage concerns. And I think that's kind of the good news. Lisa, you asked why a little bit of a more modest reaction out of the bond market for such a headline beat. And I think that's it, is that you're seeing kind of it's a strong labor market, but the wage picture isn't, at least in terms of what you see in the print today, ticking up beyond expectations, so that relieves a bit of fears. And then you look at that labor force participation rate ticking up. That's good news for the wage front.
Given all of that, though, Mohamed, why cut? I mean, I go back to what Neil Kashkari was saying. Given the fact that the U.S. labor market seems to be doing just great, what is the onus on the Federal Reserve to ease policy that doesn't seem like it's hampering this economy?
Is because policy acts with a lag. These favorable supply shocks are not going to last forever, and there are signs of weakness elsewhere. So you've got to navigate this. You've heard me say this over and over again. The mistake the Fed will make, if it makes a mistake, is being overly data dependent, becoming a play-by-play commentator, and not looking through various things. So you've got to look forward. Yes, we're having a wonderful supply shock. Has a lot to do with immigration, and that's why, as Jeff rightly says, the wage numbers are restrained. They're still not low enough, but they're restrained. But if you go forward 6, 12 months, you've got to be conscious that a lot of what has powered the U.S. so far, including excess savings, is going away.
It's the supply side story I think we all struggle with, Mohamed. When you really start to think about it, what the Federal Reserve is telling you is that basically don't worry about strong data, like payrolls growth of 303,000, because it's not coming along with stronger wage growth off the back of that, because we're embracing this big supply side phenomenon. At the same time, Mohamed, they're also pointing to the labour market as evidence they are sufficiently restrictive. And I struggle to reconcile the two things. Can you reconcile the two things? How can you use something as evidence of being sufficiently restrictive, but also acknowledge that the majority of it is supply-driven?
Because they're trying to have maximum optionality, John. And that's what they want. It's the same thing that led Chair Powell at Stanford to say, on the one hand, the inflation story has not changed after the hotter than expected prints in January, February. But on the other hand, we need more evidence that actually the inflation story is what we think the inflation story is. Look, I would be doing the same thing. They are trying to maintain optionality, and they are having competing claims. Also, don't forget that the positive domestic supply side story is countered by a very negative international supply side story. So they've also got to balance these two things out.
Mohamed, I was struck by what you said a while back, where you were saying that this is going to be a Federal Reserve that ultimately will probably accept a 2-point-something inflation rate. If you take a look at the preliminary bond market action after this report, and understanding that the first reaction isn't always the right one, this bigger sell-off is in the long end. This is basically a confirmation that this market believes that the Fed will make good on its promise, essentially, that it will cut rates at some point this year, while allowing inflation and growth to continue to run at a somewhat hotter speed. At what point does that become concerning to you, Mohamed?
It only becomes concerning, Lisa, if it de-anchors inflation expectations. I think there is a slow but sure migration in markets, even among policy observers, and certainly among quite a few economists, to the view that, yes, we're not going to get to 2%, we're going to get to above 2, closer to 3, and that's going to be stable. And the policy mistake would be to go after 2% inflation too quickly. You heard Bill Dudley yesterday, and I agree with him, saying, think more about a 2.5% inflation rate on average. You've heard about how asymmetrical the Fed is. when it misses on one side or the other side on inflation. Look, we're going to settle into an inflation world that's higher than 2%, and I suspect that is stable. The risk is to try to force it down when the economy can sustain a slightly higher one, because you then undermine economic well-being.